We had a very good quarter 3 as a fund, and just to put this in the context of the performance for the year. So the first quarter of this year, Mansa-X Kenya Shilling Fund delivered a return of 3.8%. We performed slightly better in Q2 to return 4.13, and at the time we were fairly excited about that because we've always struggled with the Q2 returns. But in Q3 we did even better to return 5.05% for the quarter. And we are very proud of this performance, and especially because it proves our strategy right, the strategy that we've been outlining since the year began. This performance now puts our 9-month return at 12.98%, and we feel that this is a fairly good trajectory towards which we should close the year. The top performing assets for Mansa-X in Q3, I'll just highlight them, but before I do that, it's very important to define what best performing means. So best performing does not mean that it was a best performing asset because the value of that asset went up during Q3. Most of the times within Mansa-X, sometimes it's even just that it lost value and we expected it to lose value and we had taken a short position in that asset. Moving into Q3, we had projected that the dollar will actually gain against most currencies, and it did. So if you look at the dollar index, if compared to most G10 currencies, the dollar index gained 7% in Q3. So it really battered the other G10 currencies. The main ones, of course, being the euro, which lost 6.52% in Q3. Actually, for the first time in a very long time, we saw the euro go to parity against the dollar. And now it's actually below parity. The euro are now trading at 20-year lows against the dollar. The pound also took a significant beating, losing over 8%, almost 8.5%, now trading at a 40-year low against the dollar. The yen losing about 6.7%, that's a 24-year low for the yen. Number of reasons for this, but the biggest one being policy divergence. You have the Federal Reserve aggressively increasing interest rates, while the UK and the Eurozone took some time before they started increasing their interest rates. So that divergence caused their currencies to be really beat against the dollar. But if you look at the yen, we expect further deterioration in that currency because they have actually not even changed their policy as we speak. So we expect that the dollar will continue to gain value against that currency. Other interesting asset plays that we have were crude oil. We were short crude oil. We expected a turn in the momentum of crude oil. We had seen a rise in the prices of crude in the first part of the year. This quarter, we actually saw crude oil lose almost 25%, and this was a very good play for us by being short crude. We were very confident that technology stocks will actually lose value moving into Q3. So we had very aggressive positions actually in short technology stocks. But to our surprise, actually, they did not lose value as much. And in fact, a lot of the loss that we saw in equities were in other sectors. But we still saw the Nasdaq lose 4%, which is an index that we have been short most of this year. But for individual stocks, for example, if I pick on a stock like Snowflake, where we were short, we actually saw it gain 25% in Q3. But again, this is the advantage of diversification, because if you look at other stocks where we were short, for example, Carmax lost 27%, and we were significantly short on that stock, ended up being one of our biggest winners for Q3. And again, this proves the concept of being long and short. We were also short retailers like Puma Holdings. Puma Holdings lost 23% in Q3. And that again was a very big winner for us. Some stocks we were actually long. For example, if you look at Cigna, that's a medical company, which gained over 5.5% in Q3, which was also a very good, offered a very good return for our investors. Moving into commodities, let's talk about metals. Copper, for example, we were short copper for one main reason. Based on the performance of the global economy in the first 2 quarters, we felt that this poor performance in the global economy will continue, and copper is a very good thermometer for global economic performance. For this reason, we were short copper, and we actually saw copper lose 8% in Q3. Natural gas, we saw mixed performance in natural gas. Of course, the biggest reason why natural gas has been performing the way it has is really the geopolitical events that are happening in Europe. Do we have enough gas to supply to Europe during the winter period? Do we have enough reserves for winter or not? Do we have, so those concerns around Russia-Ukraine tensions are what has been making natural gas a very volatile asset class to trade. We had made significant gains from trading natural gas in Q2, not so much in Q3, mostly because the moves was sort of erased. For example, in the first 2 months of Q3, natural gas gained about 75%, only to go on and lose that entire gain at the end of Q3, the last month of Q3, and close only 20% higher. So what that tends to do is really just wipe out any gains or losses on that asset class. So Mansa-X was able to squeeze out a return from all these instruments by being long and short various asset classes. What I've just mentioned are the top 10 that were significant winners. But it's important to note that at any one time, our fund, Mansa-X, Kenya Shilling Fund, can have as much as or even more than 100 individual positions that we are actually trading. And the ones I've mentioned are really just a few of them. But before I finish on the asset classes, it's very important also to mention the fixed income space. We were able to see significant moves, for example, in the US 10-year paper, where, for example, we saw yields for the US 10-year paper jump 27% in Q3 alone. So the US 10-year paper actually closed at about 3.83%, which is significantly high. And we think that this will probably continue moving forward. And in the local space and in the African space, we also saw a very exciting moves in the African Eurobond space. A lot of our investors are usually concerned about, when you say fixed income, are you talking about trading African fixed income, and are we at risk that some of these Euro bonds will be defaulted upon? So just to give our investors comfort, how we trade a lot of these asset classes is within certain set limits. There's still a lot of good value. There's still a lot of good value that you can derive out of trading some of these. Just to give you an example, the Kenyan 24-year Euro bond at some point was trading as high as 21%. As I'm making this video, we are back to as low as 13%. That's a very significant move in a bond that will accrue a lot of value to investors who are able to know when risk has been overpriced. So for example, here at the fund, we felt that risk had been overpriced at the 21% levels, and we're very aggressive in investing in the Kenyan Euro bonds at those levels. And the fund benefited mightily as yields dropped towards the end of the quarter. When election results also normalized the country's economic outlook. So some of these things are things that we do within the fund, but within certain risk parameters. And we just want to give our investors comfort that we are always watching out for some of these concerns that they have around whether governments will default on such papers, which in our opinion, we actually do not think that they will. We feel that a lot of African economies, especially Kenya, are very robust and able to manage their debt. The currency that we actually accumulate when we are making various investments globally is actually the dollar. And as you've seen over the last 1 year, the dollar has continued to strengthen against most currencies, both locally and internationally. And this means that for most of our asset classes that we've invested in, the value of those investments have actually been slightly higher purely because we actually invested in the dollar as a base currency. We expect this to continue as an advantage, and even just listening to our clients, we've had some clients who've asked us, why don't you then create a pure dollar denominated fund? And we listened, and we have been working on this for the last 1 year or so, and now we are happy to announce that just starting this quarter, as an investor in Mansa-X, you can actually come and tell us, do you want to invest in the Kenya shilling denominated fund, or would you prefer the dollar denominated fund? And we already seen a lot of traction in this, and we expect to see more traction in this. And people will probably ask, why would you then create two different currencies for the same fund with the same strategies? Because just to be clear, the strategies are very similar. The reason for this is because some of our investors have different currency receivables. So if your receivables are in shillings, meaning, for example, your salary or your business or your rental income is in shillings, then it makes more sense to be invested in the Mansa-X Kenyan Shilling Fund. It removes your currency exchange risk. If your receivables are in dollars, so if your salary, rental income, or your business income is in dollars, it makes, again, more sense to be invested in the dollar fund so that, again, your currency exchange risk is eliminated. But just to be very clear, within both funds, there's the advantage of having most of our cash in dollars, which allows us to really benefit from the strength of the dollar moving forward for both funds. So as we've always said before the start of every quarter, our outlook is really just dependent on any historical data that we've had in the previous quarters, as well as the trend that we are seeing in macroeconomic factors. So right now, what are we looking at? We're looking at elevated levels of inflation. We're looking at a sharp rise in interest rates. We're looking at a strengthening dollar across the globe. And we are looking at concerns around consumer spending and company earnings. So just going back to the inflation levels, right now the US inflation is at about 8.3%. That's what we closed for the quarter. Moving into this quarter, just for this month alone, we expect that to drop slightly, maybe to 8.1%. But we don't think that this will change the Fed's hawkish rhetoric. So we still think that we'll continue seeing the Federal Reserve increase in interest rates. We saw the first 9 months of this year, we saw the Fed increase interest rates 3 times, each by 75 basis points, which was seen as pretty aggressive to take us to the 3.25% level where we are now. We still expect that in Q4, they will even be more aggressive. We expect that they might increase the Federal Reserve rate by at least 125 basis points, taking us to 4.5%, and that's extremely aggressive. But we feel that they need to do this because the Fed has made it very clear that they are now more committed to managing inflation than managing growth. It's more important that they take inflation back down. The number that's actually pushed out there is 2%, is the inflation that they prefer, and we are at 8%. So that tells you how much needs to be done. The Federal Reserve balance sheet is still pretty big at $9 trillion, and we expect that that's the next tool that they might use, what you call quantitative tightening, where they now start reducing the size of their balance sheet. So there's still a lot more excitement to come. But one of the things then, as a factor of what I've just said, is that then we expect the dollar to continue strengthening. So we expect to see a weakening of most currencies around the world against the greenback. And the question then becomes, how does this affect also earnings in the US for most of the US companies? And how do these earnings then affect shareholder returns? So will we see a weakening of the US stock markets, and will this infect the rest of the world? And speaking of stock markets, we are almost at the pre-pandemic levels in the valuation of most US stocks. And that means that we are almost at what you call an inflection point, meaning that either US stocks gain value from this level or continue to lose value. And in that case, then we'll see and will be confirmed to be in a recession, which is something that is a shadow that looms in the background now. We're constantly thinking about whether we are about to go into a recession. And the way things are going, all likelihood it points towards that. We will also be very keen to see whether consumer spending will affect company earnings. Of course, when there are fears of a recession, the first thing to reduce is consumer spending. So you have people worried about how much they spend and should we be saving more and so on. And by doing this, how does it affect company earnings? And in fact, as well, the company earnings reports that we'll see in the fourth quarter will help us to confirm whether this has already been happening anyway for the last few months. And that's why we are very keen on seeing those company earnings. It's also a very interesting period for investors because if you have a weakening stock market, then you typically expect that maybe bond yields should also be, you'd expect bond prices to also be sort of a nice safe haven for you losing money in the stock market. But right now it's not. It's actually a very strange time that you have the stock market losing value, and what was considered a traditional haven for your funds, which would typically be gold and bonds, they're also losing value. We've seen gold lose value this year. We've seen the bond prices drop this year. Now, it means for investors it becomes a very difficult period on how to manage your money. So as an investor, then you then have to consider two things. The first one being, what is your long-term objective? If your long-term objective obviously should be wealth accumulation. So you accumulate wealth most easily by first buying things at the cheap. So right now, with a lower valuation of most asset classes, it gives long-term investors an ability to get most of the assets that they favor at a cheaper price. But then the second thing that's also very important is, how do you smoothen out that risk? How do you then have a smooth curve over that long-term objective that you have? It means on the near term, you have to use very effective risk management tools, hedging strategies. Here at Mansa-X, we employ that. We employ hedging strategies to ensure that as we trade these asset classes, we are still watching the downside by using various contracts that help us to then maybe take advantage of asset classes that are losing value in the short term. And for investors, those are the two things that you should be looking for: long-term wealth accumulations and near-term risk management. And we feel that Mansa-X then becomes a perfect vehicle to combine those two for you. So we really do the heavy lifting. Locally, the election period is now over. I think for the last 3 quarters, a big question from investors had always been, what's going to happen during elections? Are we going to lose our money? Are we safe? And so on. And we kept convincing our investors, and we were happy to prove that concept, that elections have never really been something we worry about, because our fund is invested in so many asset classes around the world. That said, we are now very confident about the new administration. What we just saw 2 days ago with the new president going for the bell ringing ceremony at the Nairobi Stock Exchange, and pushing for the listing of 10 new government entities on the stock market. We feel that sort of commitment from the government will definitely propel local capital markets into what they used to be about 10-15 years ago. This is something that we have always been asking for. We have always been asking for new listings in the stock market. We've always been asking for government goodwill, essentially, and just listening to the president has given a lot of confidence in the local stock markets, and we feel that this again creates more opportunities. I mean, because we do not only invest in asset classes outside Kenya, we look for opportunities everywhere around the world, and if we get them in Kenya, it's even better. So that again gives us a lot of confidence, at least moving into Q2 and moving into the rest of the next 12 months, at least based on what the president said, which is something that we are very excited about. Finally, we'd really like to thank our investors for continuing in this journey with us. It's actually been a very exciting journey. Just thinking about how far we've come from having to explain the concept of an alternative investment fund, trying to explain the concept of a long-short multi-asset strategy fund, and a lot of investors, most of whom had never heard of these terms before, believing in us and bringing their funds into Mansa-X. We really don't take it for granted. We really appreciate it. We've seen a lot of investors in Mansa-X not only continue to remain invested with us, we've actually seen them topping up, and we are really happy about this. Just looking at the growth of our fund, when we closed Q2, we had assets under management of about 9.3 billion shillings. We grew that by about 1.75 billion shillings in Q3 to close at 11.05 billion as at the end of Q3. This is thanks to our investors, whom we're very glad to be associated with. Just moving forward, I want to emphasize again that Mansa-X is truly designed to squeeze out an above average return for investors, and at the same time protect investors' liquidity, meaning the ability to access your funds. It remains very paramount and very important to us here at Mansa-X. Protecting how easily you can access your funds is very important to us. And then number 3, just protecting the downside risks of your funds also, again, is very important to us. That's why I keep emphasizing the fact that, number one, we are very well diversified. I mentioned that at any one point in time, we have over 100 open positions that we are actually trading. All of them, again, in different directions, whether long or short. And that's very important, because diversification is not simply buying many different assets and throwing them in the basket. It's also diversifying in terms of asset class. So for example, if I am long equities, for example, I might be short bonds, for example. I might be long commodities. I might be neutral on maybe currencies and so on. Having different asset classes and then having a very good portfolio mix of all this is what creates a truly diversified portfolio. And moving forward, we want to enforce our commitment to our investors that this is something that we'll continue doing. We'll continue also innovating within the fund, because again, we've always had some investors ask us, as a fund grows bigger, are you able to continue delivering the kind of returns that you have been delivering? In fact, it's actually the other way around. As a fund grows bigger, we might be able to make a better return for our investors. And why is that the case? Because now there are certain instruments that we were incapable of accessing before that now we can access. All right? A simple example, for example, is something like private equity. You can't get into private equity unless you're managing significant amounts of money. And that is why the bigger the fund grows, the easier it is for us to make something called alpha. Alpha meaning we can give you a higher return and actually reduce the amount of risk utilized to make that return. So just to give comfort to our investors, the bigger the fund grows, the better off we all become in the end. And we have seen this happening thanks to the support of our investors, and we thank you very much. Thank you.